And we're live. Welcome everyone to CapitalCosm Live. You know, I'm gonna call this show CapitalCosm After Dark because we always do this show at night, right? So, welcome everyone. We've got an astounding show for you tonight. We're gonna look at a signal that I think may have predicted the fall in silver prices as well as the other metals as well on Friday. I haven't seen anyone talk about this, so you're gonna want to tune in for the entirety of the show as we kind of move our way through. But before we do, hit that like and subscribe if you haven't already. Hit the bell notification to be alerted whenever I go live and to help promote the show on the algorithm. And so with all that said, nothing in this video is financial advice. I am not a financial advisor. Please do your own due diligence. And let's kick it off right now. Let's take a look at where we're sitting at right now when it comes to the price of silver. 83.24 right now here on the futures price. They've got $4,800 on gold, $5.88 on copper. Now, it's been a wild day. Last night, we hit a low of $71, and we spiked up to 88, and today it's just been a slugfest between the buyers and the sellers. Huge volatility, and this thing is not normal. Let's also take a look at where we are in Shanghai. So this is a pretty cool website. It's basically got the Shanghai spot price here as well. Shanghai is currently trading at $104 for the price of silver. Now that is a $20.82 premium. That takes you to around 26% premium. That is bonkers. I don't think we have any other premium in arbitrage existing in any other metal right now. As you can see here, spot price currently 82.74. If you look at gold, gold also has an arbitrage, but it's actually on the negative side. It's actually, Shanghai is actually discounting the US spot market. US spot right now is at 47.82. Shanghai at 47.31. Very interesting. And it doesn't seem like we have any data on platinum and all the other metals, but platinum has also taken quite a hit the last couple of days, down to 21.67. Hit highs as near as 2,900 earlier last week. So let's go ahead and dive right into the nitty gritty here. So this is what I want to show you guys. This is a chart, and I'll make myself get out the way here. This is a chart of the silver price relative to the M2 money supply. Now, the reason why we do this is because if we price silver in USD fiat terms, then we effectively are measuring it against a moving target because they're only adding in to the money supply. They're never taking out. You know, there was this one instance in, I believe, 2023 when the M2 money supply went down. But that was because, I believe that was because you had money rotating into the treasury market, which is not calculated for in the M2 money supply. However, when you actually account for the M2 money supply and you measure the price of silver relative to the amount of money sloshing into the system, you'll see something interesting. You'll see that we actually have not hit an all-time high in silver. The nominal price is at an all-time high, but when you take into account every single dollar in circulation, we actually pretty much, now this isn't perfect, but we actually hit a resistance line. And this resistance line stretches back 60 plus years. I've shaded it here in purple. And you can see, again, it's not perfect, but this resistance line, you know, we touched this resistance line back in 2011, and we also touched it in the 1980s. Now, there's a lot of trading that went on at this point here, creating resistance at this level. And it's very interesting that as soon as we hit or got close to hitting this resistance line, we saw a massive drawdown in silver. Now, here's what's also interesting. You can draw a you can draw a trend line from this point in the silver to M2 money supply ratio, extend it out. Oops. And then if you look at this thing from a logarithmic perspective, you can effectively draw this trend line here, connecting it to this top here in 2011, and you essentially get a perfect view of where we stopped selling. Check that out, like to the T. So this is on the monthly candlesticks, guys. So we closed out January here. As soon as we touched this line, the selling stopped. And I don't think anyone said, I haven't seen anyone talk about this. If you guys have seen someone talk about this, let me know. But I personally have not seen anyone talk about this. So this is astounding. So not only do you have this resistance line that precipitated the correction down, you also have this support line that created the bounce back up. So this is, I mean, I was just looking through the charts all day trying to figure out a reason why, you know, any sort of signal as to why we crashed down on Friday. And this was very fascinating because it seems like you've got a confluence of evidence here. You've got the resistance line at the top and you've got this support line here that perfectly matches everything. And these are lines that go back decades. So the validity of these lines is strengthened by the fact that their duration is so long. And then you can also see a similar pattern here when it comes to the gold price relative to the M2 money supply. You'll notice that gold actually broke out. You can draw a similar resistance here. It's not as perfect, it's not as clean and crisp as the silver one is, but it's pretty good. You'll see that we actually broke through it, came back down, and we're pretty much right on it right now. We pretty much bounced up, and you can draw a trend line as well, connecting this high here in 88, this high here in 2011, and the current high. And if you look at it from a logarithmic scale, 1, 2, 3, it's a perfect fit. And look what we have here. As soon as we touch that line, now we went a little below it. Again, it's not perfect, but perfection is the enemy of the good. This is the signal here, guys. As soon as we hit the support line, we bounced back up. Now, here's the interesting part. When we look at this thing from a one-day candlestick perspective, take a look at these wicks. Anytime you see these wicks drop down, this means the price got as low as the very bottom of the wick. But what happened is we closed at the very bottom of the candlestick. If it's red and if it's green, we close at the top. Now, the current one is currently ongoing, this one. But you would think, and I talked to my guest today, Adrian Day, about this, and he concurred. You would think that with such momentum to the downside, you know, the old adage goes, don't try and catch a falling knife because of the momentum. The momentum was stopped. It was basically a bounce back up. It pretty much ceased at that $70 level. And then when you look at it from a long-term lens, this is from a multi-decade lens. It goes back to the 80s, if not longer as well. You'll see the signal here. And you see it in gold as well. Although the resistance line on gold is from an upward slope. So let me know what you guys think. I've been trying to find signals as to why Friday happened so we can kind of learn from it. And I think this was very interesting. You also see it in the mining stocks through XAU. Now, it's not as crisp, but XAU also has a similar XAU relative to the M2 money supply, that is. And you could draw something like this. Again, it's not totally perfect, but you were range bound in this zone here in the XAU divided by M2 money supply. XAU is your long-standing gold and silver mining stock index. Now we did break out of it, and we're still above the resistance. The resistance here, but we have corrected down a bit. But the interesting part is, here's another thing that kind of fuels the argument that what we're seeing is, it's very strange, because what happens in these kind of scenarios is that when you do see sell-offs to this extent, to the volatility that we saw uh, late last week and earlier this week, and I mean earlier today actually, you would expect the mining stocks to take the brunt of the hit, which they didn't. The mining stocks actually stayed far more resilient relative to the physical metals themselves. Now, this is odd, because if this was a full-on crash, liquidity, I mean, all of these mining stock ETFs, these mining stocks in general, would be prone to liquidation. But that didn't happen. The metals actually fell further than the mining stocks. So that's interesting as well. Because if this was truly a bearish indicator for the metals, the mining stocks would, you would see de-risking, because the mining stocks are essentially a bet further out on the risk curve of the thesis. So the further out you get, so if you bet on the mining stocks all the way out into the junior mining stocks, you're going further and further out onto the risk curve. You're taking more risk. And so when things begin to unwind, clearly what happens is investors start to sell off their riskiest assets, i.e. the stocks in this case, and then they go into and sell off their, their physical holdings and that kind of stuff. That did not happen. So you've got that. You've got the bounce back up that we just looked at a few minutes ago when it comes to the wicks on the candlesticks. The buyers clearly overpowered the sellers once we hit $70 silver, and now we're back up to 80 some odd dollars or something, $81. It's just been going all over the place. It's a very strange market. And then what we kicked off the show with, this ratio here, silver relative to the M2 money supply. When you control for the M2 money supply, you see this resistance here. And clearly, it seems like this may have been some sort of contributor to the catalyst that we saw happen on Friday. Now, am I saying it's because we hit this resistance? No, but it's just a very strange coincidence. As soon as we hit this resistance, which is where we were in 2011, it's like something was triggered. Maybe it triggered the algos. The algos may have been looking at ratio analysis, pricing silver relative to the M2 money supply. Once we hit this level, it may have triggered a sell-off across the algos. So that could have been a possibility. So some very interesting things. I'm curious to see what you guys have to say. So let's go ahead and also take a look at, here's another clue as well. When you look at this PSLV, the Sprott Physical Silver Trust, and you look at the discount to NAV ratio right now. Now, when the crash happened on Friday, we were trading at a discount to NAV of what, 10 plus percent? So that means that the silver that they had on hand, that they had at the trust, was being discounted 10% on the basis of the share price, i.e. the share price should have been 10% higher to match the volume of silver that they had in the trust. That means retail buyers or retail investors were selling off the PSLV vehicle at a rate that far outpaced its actual value. Now, today, as of February 2nd, it's only down 4.9%. You go from 10% to 5% just about. And the last time we hit a 10% discount to NAV was during the COVID sell-off in 2020, March of 2020. So if this was really a speculative boom, as a lot of people were making it out to be, you would have a premium to NAV. You would have more buying onto this PSLV vehicle that it would outpace the actual valuation of the silver that it had in its coffers. That didn't happen. You also have SLV. I don't think SLV has updated its discount to NAV ratio yet, but I'll refresh it and see. SLV is a much bigger silver trust ETF. It's the biggest silver trust ETF, actually. And no, they haven't. But as of January 30th, it was sitting at 19.3%. So massive discount to NAV on SLV, massive discount to NAV on PSLV. We do have the PSLV data for today. We're back up to 4.9%. This is about the same level we've been kind of hovering around now for several years. Now, notice we've been at a discount to NAV in PSLV for years now. You know, anytime we're below the zero line here, we're at a discount to that net asset value. So all sorts of weird stuff is going on, guys. Hit that like button if you haven't already. I don't think anyone's pointed this stuff out. Like this ratio here, I don't think anyone's pointed this stuff out. So if you got value out of this, hit the like and subscribe. Comment down below. Let me know what you think. Hit the bell notification. And if you're looking to add into your stack, of course, consider the Bullion Standard Pro. We do have a special 10% off discount for the first month of membership. And it's essentially the Costco model where you pay $35 a month, but you get access to their pro pricing, which is essentially as close to wholesale pricing as you're going to get. For example, on a 1 ounce silver round, retail currently goes for $92.26. Their pro pricing currently goes for $84.86, netting you $7.40 in savings. If you buy 20 of these, you're going to save $135. If you buy 100 of these, you're going to save $619. And if you buy 500, you're going to save $27.93. Now, just by paying $35, you're going to save multiples of what you paid for in your monthly subscription. So it basically pays for itself, especially if you buy in high volume. So that we have a special link down below. Use promo code COSM10 at checkout and take advantage of it now. So this is going to be a quick one, guys. That's all I got for you tonight. But yeah, talk amongst yourself. Let me know what you think about this ratio. This is an interesting thought. I didn't want to keep it to myself. I wanted to let you guys in on it, and maybe you guys can expand on it. Maybe you see something else that I don't see. But let me know what you think. Do you think it has something to do with it? And I will read the comments, and I will catch you all next time. Thanks for watching. Have a good night.